to another episode of the Straight Up Chicago Investor Podcast. I'm 𝗤𝘗𝗄𝗏. With me as always is 𝗦𝘃𝗶𝗶𝗵𝘁. Mark, how's it going over there?
So I am looking at you in this new room with your new studio. I hear an echo. I could smell the brand new drywall. I could smell that new house smell. Like, this is it. It's your first recording in the new house. How is it?
First recording it in the new house. We moved in one house over. We had bought our neighbor's house, which has been a long process. We moved in over the weekend. We don't have really anything here yet. So if you see my background, it's completely bare. But yeah, we're here. We're excited. We got a lot to do. A lot going on.
So you took a house, you took your neighbor's house and you rebuilt the whole thing from scratch. A lot of people, in their personal residence end up, whether it be putting too much into it or they don't buy it for investment reasons. I mean, is this going to be a good investment long-term for what you did to the property, or is this just investing in your family and your future there?
It will be, so it wouldn't hit like our numbers for a flip. It could have if we went that route. We obviously didn't, right? Instead of spending $5,000 on cabinets, you spend way more than that, right? By a huge multiple because it's your wife's kitchen. It's completely different. So like we blew through those numbers. This was almost like a 2-year process though. So the numbers actually would have worked out just by dumb luck because of just how much things have gone up, right? We bought this, it took a while, we leased it back to her, a ton of time has passed and the market has gone up. So it would have almost worked out if you had planned it that way. But no, this is definitely this is not through an investor's lens whatsoever. This is our house. This is where we're anchoring down here. And nice. So you make decisions accordingly.
Nice. So I'm excited to see the new studio unfold. You got your own office now, right?
I got my own office. It's echoing pretty bad in here. Jimmy, you're gonna have to do some work because we got nothing in here. I went and stole the placemat. That's the one little rug we have right here. So that's what we're working with.
Listeners, literally before I said, Tom, you're echoing pretty bad. He goes, let me go grab a rug. And he went and grabbed like something that was sitting in front of your counter to do dishes on and put that in there. And it kind of made me laugh. Like, that's not going to do anything.
So no, we're here. So what's up with 𝗤𝘃𝗲𝗀𝗵𝘁 Realty? What do we got going on? What's our housing provider tip of the week?
All right. So our housing provider tip of the week is on the buy side. People are buying properties, 2, 3, 4 flats, and they might buy one vacant or they're buying them all occupied. I think one of the important things that I'm seeing people miss, because people buy these 3 flats or 4 flats and they bring them to us to GC to manage, and they're not really taking into account the current condition of the unit. They say, oh, these 2 tenants have been here for 12 years. That's great. But in the next couple of years, there's a good chance they're going to move out and you're going to have a huge turnover. Or, the Section 8 tenant's been renting from our place for the last 6 years. In the next year when they move out, you're going to have a huge turnover. So, some of these houses that people are bringing us, and I try to do the right thing in early on before they even close or before they hire. It's like, hey, listen, you got 2,000 square feet of a house here. Just to paint this place alone, you're going to have a chunk of change when this tenant moves out. Or, hey, in the home inspection for your 3 flat, all these units kind of tied together, they're really beat up. And even if this tenant is there, and you might be able to get 25% or 30% more in rent when they move out, you're going to have $8,000 or $9,000 turnover for some of these because you're going to be replacing flooring or you're going to paint the whole place. You're going to have a punch list that's going to have, you might replace a couple of doors. So make sure when you're buying these occupied properties that you're really, you're looking, I know all you investors are out there looking at your roofs and you're looking at your hot water heaters and your furnaces and your other CapEx items, but look at that first turnover. What's that turnover going to cost you? And I think that's something that you got to make sure you're incorporating in your numbers. I think being mentally prepared sometimes is just what you need to be for that.
Absolutely. And just in general, not even that first turnover, I feel turnover is missed a lot, right? People say, oh, I'm going to have this percent vacancy, just some random percent they pull out of their head. But there's a true cost of turning a unit over. And especially if you have it professionally managed, then you're also giving up, a month, half month, whatever that is. There's a true cost there, right? You need it, which is fine. Those things all exist for a reason, but you need to account for it up front. And if you don't, you're going to get blindsided.
Yeah, no, very, very. Everyone really underestimates the cost to turn over a unit, which goes back to the effort to put into the renewal piece is that much more important. In most cases, and I don't encourage this, but you could probably reduce a tenant's rent and still be ahead of the game than having to do the turnover many times. So,
yeah, absolutely. All right, let's jump in today. Condo deconversions.
Yeah. So this is a topic that I really like. I started my career, I started into condo conversions. So, I mean, I literally cut my teeth in real estate, selling hundreds of condo conversions as a broker and investor too, as well. So doing the opposite here is funny how things come full. It's not full circle, 180 degrees around. So, and Tom, this is a fun fact. This is, we've had a couple of guests that have came back that have had the same guest back for a second time. But this guest today, we have two guests with the same name. So I thought that was a little fun fact I was thinking about this morning. But our guest today, he's not a Chicago native, which we were giving him a little hard time of before, but now he's here and he insists that this is where he wants to be. So we're excited for that. But Sean went to undergrad school at Boston College. He played lacrosse and law school. He went to law school at University of Missouri. He's been the designated co-star power broker 3 times prior to joining 33 Realty, where he's at right now. He learned investment brokerage at a boutique in Chicago, which is awesome. He has been with 33 for many years now, and he leads his multifamily division. And they have a whole bunch of other things they do, receivership, and now we're going to talk about today the condo deconversion. So, without further ado, I want to introduce Sean Connelly from 33 Realty. Sean, did I cover everything in the intro? Did I miss anything? Did I do anything correct?
No, that was great. Thanks, Mark. Been in Chicago for a long time. I think it's the best city here, but always good to get on with you natives and talk about what's changed in the last few years.
I'm hearing a little in your voice. You got a little of that Chicago tone in there. So it sounds like you're settling well.
Yeah. You talk to clients all day. It's going to rub off eventually.
How long have you been at 33 Realty now?
So I've been at 33 since 2016.
Nice. You guys got an awesome team over there. That's cool.
Thanks.
Deconversions. I really want to break this down. I think I've learned a lot about this in the last 6 months, and I think a lot of people are hearing about it in the background, but don't truly know what it is. So kind of talk to us, like I said before, I'm experienced in condo conversions back in the day, which are really not existent at this point, but deconversions, kind of what is it and where do you see it happening?
So ironically, when I first started, we were doing the same thing you were doing. So conversions, and then the wheels fell off. Nobody was buying those type of assets. Those entry-level condos have gone down in value even from the peak of 2006. 2006, 2007, you were seeing record pricing for condos as they were selling. And finance was very simple then. You were getting no loan docs. People were getting very aggressive terms, and they were buying entry-level product. Now what we are seeing is that there are more renters than there are those entry-level buyers. And people are staying and renting longer in apartments, and the apartment value of these condominiums is actually higher than the condo value. So simply put, deconversions are taking buildings that probably never should have been turned into condos and turning them back into apartments.
Now you're seeing a lot of condo buildings that have been condos from the existence turning into apartments. What really is it? Just the value? Is it the amenities? What else is driving kind of this this surge of deconversions?
So it's a number of things. First is that number one is that the value is higher as apartments than they are as condos. The reason that I say that when we're looking to target a deconversion, we underwrite the building. We use our leasing team to justify the numbers. We can find everything on public records as far as MLS unit mixes. We build our own rent rolls. We then come up with our income side. We apply our management similar to what you would do, Mark, and say, this is what our expense loads should be on these type of buildings without having necessarily the full T12. And then we apply a cap rate to it on a post-rehab guess on where the rents will be. And if there is a spread looking at that to what the retail condo sales are, 15, 20% or more, we've got a pretty good shot that people are going to be interested in hearing about an offer to deconvert, especially if there's a lot of investors, because a lot of these were snapped up over the recession at cheap prices. So if there's a lot of investors in there and there's that spread, there's a pretty good chance that they'll at least want to entertain as an association a deconversion.
Very basic 101 question. T12. Explain to people what T12 is.
Sure. Sorry. So trailing 12. So when we typically look at a multifamily transaction, we're getting a rent roll that shows you every unit, who's in it, what they're paying for their rental income. And then we're getting a trailing 12 of expenses. So we're looking at the utilities, we're looking at the taxes, we're looking at the turn costs. You're not going to get those on deconversions because you are literally pulling all of this information together for public records. So you have to be able to model the expense side by just operating a lot of properties. And because we have our own property management department, we can basically take a building that we're looking at for deconversion, compare it with something in our portfolio, apply an expense load, and then we don't need all of that detail that you would normally need to value an asset.
So from the HOA side, then, are they looking at saying, well, if we're valued at this market for each condo, we want to get that plus 20%? Like, is there some magical margin? Like, I'm assuming as a whole, they're worth more than the individual parts. Can you talk through how is that appraised? What are the expectations from the HOA side?
Yeah, so it's only going to work in our experience if there is that premium to where the condos are selling. We've seen premiums at the beginning of this when there weren't that many people doing it. We've seen premiums as high as 50-60% over where these condos are selling. These condos are typically not a $400,000 condo or even a $250,000-$300,000 condo. Maybe they're trading between 80 and 120,000 as condos, and you're coming in and paying 150 to 160 as an apartment deal. So those thresholds at a minimum, I think need to happen in order to get a successful vote. But you can have greater and fail, and you can have less and succeed. It just depends on the process you run and really the individuals that are making the decision within the association and what's important to them.
Before we keep going down that path, like how'd you guys get into this? This is a very unique, and there's only a handful of players doing this in the Chicago market. How'd you guys start? How'd you guys say, hey, let's go specialize in deconverted condos? Like, how'd you get there?
Ironically, it's really a supply and demand issue. We don't see as many traditional deals trading hands as we once did. We're not selling courtyard buildings all over the north side of Chicago. Investors really drove this. I'll give credit. Some investors give a shout out. I think Larimar was probably the first group that did a more modern deconversion. There were ones that were done all the way back into the 70s, but they did one in the city. And I looked at it and said, well, this is pretty interesting. What did you guys do here? During the downturn, I did a lot of bulk condo sales. So I was selling when a developer failed and there were a lot of condos left. I was selling to investors, and I knew that I had a lot of clients who had a lot of bulk condos that were sitting in these deals. So we figured it out. And as we dug into it and figured out how to do these, we just kind of fumbled through our first 3 or 4. And then got better and better each time we did it, tried to make it a process, streamline it, and really make it easy for everybody involved. And then we realized there's a ton of these. There's so many of these. You just need to target the right ones and then approach with very aggressive offers so that you don't waste everybody's time.
We say there's tons of these. Talk to us about like volume. Like what is that? Like how many of these deals? I'm sure you got the numbers. How many of these deals got done in 2020, 2021, or estimate if you don't got the exact, but is there hundreds of these getting done? Is there 30 or 40? Like
roughly, there's probably about 50 or 60 of these getting done in any given year, with more coming as people continue to the financing and the investors get more cognizant of how to do these correctly. They are normally larger deals because they are just as painful to do the small ones as they are to do the large ones. And a lot of the city product, a lot of it was taken offline quickly. There were a few groups that really took down a lot of these larger buildings downtown. You got the Strategics and 𝗬𝗏𝗏𝗵𝘁 and all of these large institutions that came in and picked these up. And then the threshold changed to 85% in the city. So we've really focused on the suburbs. So we've been going after the suburbs. And what we're finding is that there are a lot of people that are open to exploring this. And there are also a lot of investors that, because there's no product out there, they're willing to put in unsolicited offers. So we underwrite the deals, we talk to the investors, they put in an offer, and we go from there.
What's the acquisition strategy? Like, are you going after the HOA board? Are you sending mailers to the individual condo units? Because you kind of need a lot of buy-in from a lot of different parties. When you're trying to go after these on the acquisition side, you don't have to give away the secret sauce, but who are you targeting?
No problem. Everybody. It really depends on how the HOA is structured, who's involved from an ownership perspective. I mean, we're looking at deals to see that there is a large percentage of investor-owned units. If you go after a building that's 80% owner occupied, it's probably not going to deconvert. You don't want to waste your time on that. So we data mine. We try to be smart about where we spend our time, and we use statistics that we can pull to figure that out. And then from there, we're talking to anybody who's a part of the association that we can get to. Sometimes it starts with someone who just has an in at, they own a unit and you know them and they bring you in. And, for every deconversion we do, we probably talk to 5 other associations where it doesn't happen or we value it and it doesn't make sense. And our thought has always been, this is an education process. So you get in however you can. And then from there, you have candid conversations and you walk people through and demystify it and then figure out if it's worth pursuing.
I imagine these deals got to take a long time. Like what is from the day your buddy that owns a condo in the place starts talking to this conversation to the day maybe you actually close with an investor? Like what type of time frames are you talking?
They're massive. So, these things never get done quickly. I think the fastest one I've seen done is probably 6 months. In general, these are almost like land plays where you're going through entitlement. It takes a long time. There's a lot of meetings. There's a lot of explanation. You have town hall meetings just like you would when you're going in front of a neighborhood group. So the fastest 6 to 9 months, sometimes these take a year or more. If we've underwritten a deal, we've got it in our underwriting, so we can always revisit it as things change, as interest rates go up, as values go down for condos. So, we anticipate that these are going to be going on for some time. But once you're under contract to close, in general, we're looking 9 to 12 months on the short end, with probably 6 being the quickest we've ever done.
How are you said town hall and it kind of triggered. I got a lot of questions, so
please,
Tom, please keep me under control here. You said town hall and it triggered my mind. Like, how are, whether it be aldermen in the city or the villages, how are they looking at this process? Have they been enemies to this process? Have they been on board? Like, what's the take of adding more rentals versus condos to them?
It has, we haven't run into that much resistance from the government entities. In general, you don't need to get zoning approval change to do these. It's really dictated by Section 15 of the Illinois Condominium Act, which lays out that if you get 75% of the association to vote in favor, it drags along the other 25%. And there's ways to protect that 25% as well. In the city, it's 85%, as I mentioned, but the villages and the town halls haven't really gotten involved. I'd say the city of Chicago has probably gotten more involved than anyone else when they changed it from 75 to 85% within the city limits.
So it's dictated by Illinois condo law. It's not based on individual bylaws. Now, if individual bylaws were written at 60%, would that then be overruled by state law? Is that how?
So the higher of the two is where it'll go. So if you have something that said 60% in the decks and bylaws, but the law is 75%, it would be 75%. But we've done associations where the bylaws said 100%, but then the ownership votes to change the bylaws to get it back down to 75%. So if it's at a higher percentage, that's what you have to do unless you get the bylaws amended.
For anyone listening, decks and bylaws, that's really the legal structure in writing in a 75 to 120 page document. That's all boring legal stuff that really governs the HOA. And every HOA has this. And it's actually, it's a recorded document too. So if you ever wanted to see, hey, if you want to research an HOA, you could always go up on public records and pull that up on the county recorder of deeds.
Yeah, you can figure out who you need to talk to, right? Because you go to cookcountyrecorder.org, you can pull out you only need one condo pin. You can pull off the bylaw from it, and you can see who is basically running the board, right? It's probably
it may be dated,
the phone number, the office number, etc.
Right.
Hey, so you mentioned investor friendly condos make a lot of sense, right? Because you're not dealing with the homeowners and the sentimental part of it. What happens to those tenants? Do you assume those leases, are they out as well? Like what's the dynamic there?
If there's a lease in place, it's just like when you buy a traditional building. You take over that lease as the buyer at close, and you assume that tenant.
Okay, so their life doesn't change, basically.
Correct.
Okay.
Yeah, I mean, if there are tenants in the building, they're not gonna be disrupted until there is an end of the lease that they have in place, and then it's just going to be traditional. It's leasing season, so Most of the time we see that the investors are happy to have tenants in there. They're in the business of renting apartments. So they want those people to stay.
If I am just a buyer of one of these deconversions, actually, what's kind of the expectation of the buyer? Are they coming in? Are they trying to add? Is their goal 100% of the time to add value through rental increases? Are they putting a basic? Can they expect to put a basic per square foot number in capex or kind of upgrades? Like, what's kind of the mindset of these buyers, or is it just turnkey on some of
them? They're almost never fully turnkey. The reason for that is that these haven't been professionally managed. You probably have a varying degree of unit finishes throughout. So most of the time people are coming in, their plan is to find, especially if you're going to look for a motivated association, there's going to be issues with the property. There's reasons that people want to sell. They may have a big special assessment coming. The property may just be dated and in need of serious deferred maintenance upgrades. So most of the time these buyers are coming in, they do have an add value plan. They're going to take care of the grounds. They're going to make it more attractive. They're going to put professional leasing in place. They're oftentimes going to come in and they're going to do the common space, the amenities. They're going to make it more of a rentable product. A lot of times they'll be planning on how do we maximize amenities? Where do we put a new clubhouse, depending on the size of the property? How do we rebrand this? And how do we really make this a community rather than something where there's your HOA manager who's managing this association, and then there's 400 individuals who own these units, and there's no rhyme or reason to who's running this process. So it really is taking these products and turning them back into communities.
So I imagine you have to have some interesting, so just say it's 70% investor and 30% owner occupied. I imagine from the owner occupied, you have to have some interesting experience on having to overcome their reasons why they don't want to do it. Like, how involved as a broker do you have to be in solving those, or is that on the board? Like, kind of talk to us about what you have to do to make sure you get the deal done.
Yeah, it's a lot of hand holding. It's a lot of education. What we do is we have a whole team that works on it together. We've got an email that we always set up where we can get questions, we collect them, and then we answer those questions for the association. Sometimes, guys, it's amazing how simple the questions are that end up getting somebody to vote no, that once you answer them, it turns them to a yes. The one that I remember the most distinctly was there was a deal where we missed by one vote on a deal in Ravenswood. And we went and we called everybody, and we don't know as the broker who's voted yes or who's voted no. That's taken away from us. That's audited by a third party. So we just call everyone and we touch base. Hey, wanted to see why you voted no. A lot of times they'll tell us it was money. I may want to stay longer. So sometimes you give people longer leases. But I remember in this one, the lease that came across from the buyer said no pets. And that was the only reason that this person voted no. They wanted their cat to be able to stay. The second that we had that discussion over a cat, this $8 million transaction moved forward. So you really have to communicate with people and understand what's important to not only the association, but all of the individuals within the association and what their needs are in order to move it forward.
The $8 million cat.
$8 million cat.
Right there. So, all right. So let's talk about property taxes, right? Because in a condo, everyone has their own individual PIN. They're all paying their property taxes. What happens with a deconversion, and how is that calculated? Like, how do you, as you're underwriting the deal, how do you even perform that? Like, just talk to me about that. I just asked you like a bunch of little questions. Go for it.
Oh, no, it's a great question. So first, I'll go out and say that I'm not a tax appeal attorney, and you should always consult your tax appeal attorney. But in general, when we first started doing this prior to the new reassessment coming out, most of the time you were seeing that you were getting a savings when you were deconverting the building. You can deconvert it at the closing table and get it back onto one PIN, and then get it taxed at a multifamily level that traditionally is lower than where the condo taxes are. Given what's been going on recently, I've had clients who've actually said, you know what, we're going to wait to see what's going on with multifamily taxes before we decide to actually move this to one PIN and then knock it to multifamily tax status. So you really have to look at both. It used to be a given that you were always going to save money and you were going to knock your taxes down. But now I have clients that have actually come in, they've gotten rid of the board, but they've kept all the individual PINs as condos. and they're waiting to see what happens before they decide how they're going to move forward. And as long as your lender understands what you're doing, that you have full control, we haven't seen any issues with investors doing that.
Makes sense. And then from the mechanicals, is there anything like typical, hey, we're going to deconvert, we almost always have to do X, Y, Z? Or is everything really behind the walls usually just stay in place and pretty straightforward?
Say that again. I'm not sure I understood that question.
Just the way utilities are separated and so forth. Is there anything that you need to do just as far as like, oh, it's going to be a value add if we can separate these, et cetera? Like, is there a typical game plan when you're?
Yeah, I mean, most of the time, money went into these buildings when they were converted, or when they were built. They're separately metered. So most of the time, you're not dealing with central boiler systems. Sometimes you are, but it's very rare. I think a lot of those deals traded early. I know one of the ones that we did in Lakeview in like 2015. That was on a central boiler. It had all centralized electric, and it was a nightmare. But those HOA fees were paying for that, and that buyer came in and separated the electrical and kept it on a boiler and went from there. But for the most part, you're dealing with individually metered buildings where you don't have to do too much on the utility side.
Okay. So when you're looking to underwrite then, like, hey, will this make a good deconversion? It's basically, what can we get this at versus what we think it'll trade at? But and then like the back end, like what I'm saying, like the cash flow numbers, like we're calculating your NOI, besides the taxes, everything is pretty straightforward, like a typical multifamily deal, right? Or is there any other gotchas to consider as well?
No, I mean, in general, when you're looking at these, I think the biggest thing is understanding what the value of the property is as is, plus what the value of the condos are on a trailing, call it 12-month basis. Condo values are going up right now, so that's made these harder to do. There's less of a spread to the individuals that are voting yes or no. But in general, as long as you can underwrite an as is, and then you really have to ballpark your construction numbers a little bit. That's a hard thing about these deals. We try to pull as much as we can off of the MLS so that you can see what condition all of the units were in that have traded in there. But until you get into diligence, you're not going to really know, hey, is this an original 2006 vintage, or did somebody come in here and drop in new cabinets and new appliances and we don't have to do anything? So what I would say is making sure that if you are buying one of these, you have a good team inventorying the property while you are doing your due diligence walk. So you understand where you really need to put the dollars, rather than just saying, okay, we're going to spend $12,000 per unit and then not know where you're going to put that money. You really should map it out when you get in there, because access is hard in these deals. You have people who aren't going to want to let you in. There's not a master key a lot of times. So we really have to juggle to get into the unit. So what I would say, if people are looking to buy these, is line up your teams and get them all in there when you have access. Don't keep coming back.
You know what I think is crazy? We did, in the downturn, we bought up a bunch of condos, and our goal is to buy them up and deconvert them. I think the largest building we did was 6 units, so nothing crazy. Actually, we did a 28 unit, technically almost to the finish, and then we sold it right before. But the crazy thing is the paperwork to deconvert it, remove it from the actual Illinois Condo Act was simply like 1 page written up, or call it 4 or 5 pages, signed by all the owners and recorded. Like it's such a massive, like in my mind, transaction that the paperwork to actually remove it from being a condo to a personal property owned PIN, 1 PIN is crazy how simple that is. If you don't mind, I think what I would love if you could kind of walk us through a property, kind of a process, I guess. So sure. I'm your buddy. I have I might be a board member. I might own a condo in a building that's heavy investors. And I want you to kind of explore with us what that looks like. Can you kind of walk us through high level of that process all the way up to going on the market and kind of securing a buyer? Because the order seems kind of different. You explore it, you get somebody's approval, and then you put it on the market. So walk us through kind of that, if you don't mind.
Yeah, no problem. So a lot of times we'll be approached by someone within the association. That may be a property manager who manages the property and knows that there's a lot of deferred maintenance coming. It may be an attorney for the association. It may be the board president, or it may be just someone who owns a unit within the association. So the first thing that we're going to do is just kind of a smell test. If somebody comes, remember somebody called us once and they wanted us to deconvert a building where units were selling for $750,000. That was a simple no. We're good. It's not going to happen. So smell test, you want to make sure that the price per unit where you would need to be looking at the transactions is in line. You don't want to be much over 200,000 a door. Wherever you are in the suburbs. In downtown, you can get higher. But then what we'll do is we'll go in and we will value the property. We'll get as much information as we can from the board. A lot of times they, very well run associations will know where all their leases are. So we'll at least be able to look and see, okay, these are the lease amounts within the association. If we can't find that, we go and we pull the information we can off of public records, and we build the rent roll. Like I mentioned to you guys, we build the income side, we build the expense side, we apply it, we look at the market capitalization rates, which is the cash flow of the property, and then we present to the board. So that's normally the first step. We tell the board, here's what it is. We leave it in their hands. A lot of times with the board is just doing their fiduciary duty. A lot of times we get called when somebody's already been approached and has an offer in their hand, and they want to make sure, is this a good offer? So a lot of times we get brought in just to consult on, should we consider engaging on this? And then we'll get brought in to actually negotiate higher offers a lot of times when that happens. So we give it to the board. The board has the right as the board to enter into contracts, so they can enter into a listing agreement with or without the consent of the rest of the association. We have found that can be a double-edged sword. One, you're never going to get consent that everybody wants to go market the property. So in that regard, it's smart of them to actually push it out and say, let's get offers and then we can have a conversation about sale. But the other side is people feel like the board wasn't being transparent, and now a property is being shopped that they had no knowledge of, and they feel that they're being essentially bamboozled. So our suggestion is always be transparent with ownership. Let them know early. So what we like to do is we come in and we hold a meeting for a couple of hours and go through the valuation, what this is, how it works, and really walk everybody through the process. And then a lot of times the association they'll go and they'll reconvene and they'll come back to us and say, yes, let's try to do this, or no, we didn't get the support we needed. It feels like it's pretty hostile. We're 50-50, and then no one's wasting their time. So it's really a big education process. And it's a lot of hand-holding, and it's a lot of walking through why you do even consider doing this. So it definitely takes longer than a traditional deal, but they can be really fulfilling deals, because if you end up in a situation where people get a premium on their units and they can go trade into something down the street that's nicer, or if they're an investor, they're 1031ing into something similar with a lower basis, and you get a client who gets a good product, it's really rewarding to see everybody happy at the end of these.
Got it. You mentioned the bigger deals are, it's because it's the same amount of work, whether it's 100 units or 10 units. But I gotta feel like some of those meetings with 100 units just gotta be just horrendous, right? Like I just picture scenes from Parks and Rec and people talking at the community center, just oddball questions. I don't know. Is it like that, or is there a higher? Am I have too little faith in humanity?
No, you're spot on. I mean, you basically, you get the pitchforks and torch crowd that shows up to these. I'll tell you, for COVID, one of the benefits of COVID was we started doing these as Zoom meetings. So it was a little less screaming and a little bit more listening, and then letting everybody voice their opinion at the end. Most of the time when we walk into those clubhouse rooms in these associations, people are there and they're upset, they're pissed. But once we explain what's going on and that this is up to them, it's up to them to vote if they want to do it or not. And that it's not a hostile takeover, which is how these always feel initially, I think, to the general owner within a building. Once we walk through everything and everyone understands the process and how an appeal process works, and that they're going to get above fair market value or it's not going to happen, and that we can provide them with options for moving or long-term leases, everyone calms down, and then it really gets better. But you're spot on. I mean, when you walk into some of these initially, it's you get everybody coming from the woodworks. Everybody's an expert. Everybody knows what the values of everything is all of a sudden, and people just start throwing around legal terms. It can be. I would suggest you guys go to one to watch it in person and bring popcorn.
I have been to one of them, so I felt that. So special exceptions. So you're getting these deals done, these bigger deals. There's got to be a handful of special exceptions of, people that want their cat, like use it as an example, or people that planned on living there for the retirement and they base their mortgage payment based on that. Now their rent's going to go up possibly. That's their fear. Like they locked into, people want longer term leases. Like how often are you guys having to do special exceptions to get deals done, or how often are these kind of problems thrown into the way of getting a deal done?
So you can't make separate offers. You have to offer to everybody the same thing. So you're giving a baseline offer. Now I could come to you if the building was 100 units and it was ones and twos. You take the price and you apply the percentage of ownership to come up with what the baseline value should be. What I can't do is just come to Tom and say, hey, Tom, I'm going to give you 50 grand more because I need you to vote yes. What I could do is say, everybody who votes yes by this date, I will give 5 grand more to. So you have to be fair in the way that you do everything, and you have to negotiate with the entire group. What can happen though is, a lease can be something different. If you mentioned somebody who's there, Mark, who's looking to retire there, that's something that we've come across where someone says, look, I'm in here for a long time. I really don't want to move. And if you've got a buyer who understands that these type of things will come up, they'll capitulate to it and they will work with those people. So I've seen 5-year leases entered. You can't do that across the whole building, but if somebody's there and they've lived there for 50 years, nobody's looking to throw them out. So, you make those exceptions, I think, less to get the vote and more for humanity. You don't want to be coming in and just running people out. We've had the same thing with ADA units where someone says, look, this unit's fixed for ADA. Great. You could stay indefinitely and we'll put you at a rate that's the same as what you're paying for taxes and HOA. So there are a lot of different ways to do that. And then the other thing you can do is you can bucket potential values for upgrades. So that's one way that it's been really fair to do these is say, you put aside $500,000 off the offer price, and that's for upgrades. These are the upgrades that qualify to make it equitable for somebody who's gone in and put in a new kitchen or a new bath in the last 5 years, so that they don't feel like they're getting the same price as their neighbor who hasn't done anything since it was converted in '93.
So I want to bring up an interesting point there. The price is not necessarily if you have a 1-bedroom or 2-bedroom, it's based on your percentage of ownership. And that percentage of ownership, you find that in the decks and bylaws that we're referencing earlier, right? That's
correct.
That's we figured out. So it would be basically if it was a $10 million building and you own 2% of it, your offer would be 2% of 10 million in that sense.
That's correct.
Okay.
And that's set by the original developer. We've run into problems there where the percentages have been off for what the value of that unit should be based on square footage though. And that became a real problem on a deal where there was a garden unit that the developer kept for himself and he put very little percentage to it because he didn't want to pay much of the association dues. And then when we went to sell it, it wasn't him in there anymore. And all of a sudden someone was getting hosed. So the board can make decisions there where they've got some discretionary power to figure out this is how we're going to take this offer. And maybe we make this person whole based on square footage. We take that off the top, then we all split it up pro rata. As long as it's clear on what you're voting on, then everyone can vote yes or no. So you can do those type of things if you need to do them. But yeah, in general, it's going to be percentage of ownership. But if it doesn't work on percentage of ownership, because the 1-bedrooms are getting a 50% premiums and the 2s are getting 10, we also have clients that will offer, here's the price for a 1-bed, here's the price for a 2-bed. And then they're putting it out in front of everyone for a vote. So you don't have to go the pro rata route, but it's the cleanest way to do it.
Got it. All right, so kind of shifting a little bit, let's talk about some of these smaller deals. Like let's say you have like 12 condos. Do people, like let's say you already own 1 or 2 in the building, do people look to buy, 5, 6 just to ultimately get that line share position? Like, is that an actual strategy on some of these smaller ones?
It is, except prices have gone up so much that I haven't seen people doing that all that often. I think it was the play when it was easier to stack up units. I've got a client, though I say that, but I've got a client who's just kind of done a organic deconversion of a 14 unit in Old Town, where he's just been picking up 1 unit at a time because he wants to own a multifamily building in Old Town, and then he'll put a commercial debt on it. So that does happen. Where I've seen that happen more, Tom, is where somebody will come in and from a financing standpoint, if they can get to 51%, they can get on the board, they can control it, they can get better debt. So
And
I've seen
everyone else is
offers
screwed
that
for
come
their
in where
finance.
people will write a deconversion price, or we'll take it at 15% off what our deconversion price is for 50% of the building or more. So guys will go that route as well, and then they control the board, and essentially people that are still there are participating in the upgrades to the common space and the amenities. So as long as you understand how to do that, that's another way to do it.
Got it. Man, a whole new world here.
What does the future look like this? I mean, there's only so many buildings like this. How many years before pricing goes too high or inventory runs out? Like, what does the future look like for this strategy?
It's a great question. I mean, I think it depends on where multifamily pricing continues to go. I mean, it's gone through the roof recently. So I think that as long as you can find value as an investor on the deconversion side to what you would pay on a market rate multifamily deal, and there's a spread to the individual owners that is substantial. It's not going to be 4%, 5%. So I don't know. I think for now, where interest rates are and where the appetite is, this continues. I think there are a lot of states that we are exploring there that these work in where nobody's done very many of them. So I think that there is a lot of opportunity to continue to do this. I think there was a lot of property that was converted that shouldn't have been and is better off being rental. And I also think that if condo values go down when interest rates go up, you go revisit all these deals and you see if all of a sudden the multifamily values are holding more than the condo values. So I think it's a different asset class than multifamily. I think it's weird and it's quirky, but if you figure out how to do it, I think there's a lot of value in it.
Well, while we're predicting the future here, what outlook on Chicago, right? You've lived in multiple places. You've anchored down in Chicago, which we love, right? I'm just here because this is where I've always been. This is what I know. But you've chosen Chicago. You're doing, $30 million deals, $27 million deals here. I'm assuming you're very bullish on the city, but why? For all the negative headlines you hear out there, why are you bullish on Chicago?
It's capital of the Midwest. I think it draws so many people here. I grew up in Kansas City, and I remember just watching the Bulls growing up. I always wanted to be in Chicago. Half my friends went to Milwaukee, half of them went to Notre Dame. They all came here when we graduated. You got the bars, the restaurants, you've got the young nightlife. None of that stuff goes away. You've got one of the biggest natural bodies of water in the world. I think that's going to play a big part as the West dries out. I don't think it's going anywhere. And I think as we see, there's a lot of tech jobs, there's a lot of life science jobs coming in. We're seeing better and better jobs, and the talent that you can get here as an employer is cheap. So the cost of living is expensive to us because we've watched it go up, but it's still really cheap to everybody I talk to on the coast. So I think that the quality of life here is solid, and I think it's the best city in the United States.
I love it. I love it. One last note before we wrap. I read in Crain's a couple weeks ago, the largest deconversion in I think history in Western suburbs, Glendale Heights, Stonegate. The guy that pulled that together, I think, made $60 million when he kind of put all the different segments together, and that was a failed, doomed deconversion or conversion to start. I remember I sold about 30 or 40 of them there. So that's crazy. Someone made $67 million that we know of on paper for doing what you're focusing on. So that's pretty cool. And he right here in Glendale Heights.
Yeah, and Mark, I'll tell you, once you've got the yes vote on these, it's almost like when you go and get something entitled. It's so much work to get there, but there's instant value the second you can go to someone and say, okay, we've got this ready to go. Because I'll tell you who won't do deconversions is 1031 buyers. Yeah. They don't have the time to do these, but if you've got it teed up and they can close in 90 days, there's a lot of equity looking for those type of deals.
Nice. All right, cool, man. Let's move to our wrap up. So what do you do in your position and how you do it that is unique, and what's your superpower?
I have no superpower. I am just a connector, and I like working with people. I always have. So I don't think I'm doing anything special, just kind of being myself and talking to people all the time and enjoying life.
Dang it. What's one piece of advice you would tell someone that has yet to buy their first property here in the Chicagoland area?
Make sure that you run your construction numbers before you buy an add value property. I can't tell you how many times people show up to us after they bought the property and realize that they underwrote it wrong because their construction numbers are off.
I can only smile and giggle. All right. What do you do for fun?
Play lacrosse, ski, and get outside with my kids as much as possible. I'm going to try and drive them all the way to see my brother in Boston this summer. We're looking at renting an RV and going across Canada and hitting as many national parks as possible.
I did that as a kid. Went to Niagara Falls, and we eventually saw a game at Fenway.
Nice.
And I came back and saw a bunch of stadiums on the way back.
That's a good road trip. Good parents.
It was a good road trip. I was 15, so I remember that one vividly.
I saw the Montreal Expos play the Chicago Cubs on that same road trip that we took.
Nice.
In Olympic Stadium.
What is a good book, podcast, or self-development activity that you would recommend to our listeners?
Self-development activity. I think you've got to get away from your phone. I think that we spend way too much of time on our phones. So being present is really important to me. Be present and let yourself disconnect from work, and you will figure out better things if you could just let your head go.
Awesome. Besides yourself, name one person in your local network that you'd highly recommend to other investors as a quality resource.
Can I mention my partners, or is that not fair?
Your partner is on one of the podcasts.
I talked to Drew. He's a very, very, very good at property management on the north side. So that's who I would throw out there. It's nice to have partners you can lean back on.
Yeah, we had, I can't tell you, I think Eric Weber was episode 16 or something like that.
16, correct.
Nice.
Right? Damn, I'm good.
He was an original here.
Yeah, he was an OG.
Sean, thank you so much. You provide a ton of value to our listeners. How can they learn more about you? Is there any way they can provide value to you?
Yeah, if anybody's interested in learning more about this, we've got materials. We're happy to send them around. Explore this. If you're considering doing it, look into it. It doesn't cost anything to figure out if your building is going to work or not. And we don't mind if you say no at the end.
Good stuff. All right, our Chicago fact. Mark, I think we can guess this one. Let's see. I'm gonna put a little bit of pressure on you. So I was going to do condo stats, but everything was the 2010 census, so completely irrelevant. I didn't want to say the wrong thing and have Sean correct me. So we mentioned, Sean, you've been all over. It sounds like your father was in the Air Force. So we loosely tied in that the Chicago Air and Water Show began as a family day celebration for kids in the Chicago Park District Camp program, which I did not know. Mark, what year was the first inaugural Chicago Air and Water Show? And your choices are 1942, 1959, 1975, or 1988.
I'll probably say 75. I don't know. 40. I think it all was post World War II. I don't know. 75.
Go with.
Where are you going, Sean?
I was going to agree. 75. That feels like Blue Angels.
No, it was 59. 59 or 72 would have been my guess, though. 88 is too recent. And then 42, the war didn't make sense. So I would have guessed one of those two.
Oh, man.
You did a great show, and I ended it with a bummer. I'm sorry.
Listen, man, we've talked about this off air. You got to give me easier questions so I look better.
We're running out of questions. We did this at like episode 30. Now, 80 questions about Chicago that are easy.
So you're saying you gave me all the slow pitches already. All the softball pitches. All right. Awesome show, Sean. Awesome show, Tom. Thank you, everyone, for listening. Visit our merchandise store. We just updated all of our shirts and sweatshirts and t-shirts. We have our logo now that we trademarked it. We added all the new logos with the trademark. So if you will go on there, buy something, take a picture, throw it on social media, we'll throw a shout out to you here on the show. So thank you, Sean. Thank you, Tom. And audience, we will see you next week.
Thanks, guys.
Thanks all.